Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Are you being greedy now when others are fearful? If the answer is yes, what are the kind of stocks are you buying? Are you averaging the existing stocks in your portfolio or are you buying new ones? Well, if you're sitting on a few multibaggers and are looking to buy the same stocks again, I have a suggestion for you. In other words, if you bought a stock, say in 2020-21, and which became a 10-12 bagger, but has fallen some 35 to 40% in the current bear market, there could be better options than buying more of the same stock. You could perhaps be better off buying a brand new stock than buying more of the same one. At least this is what my recent small study revealed. Now take a look at this portfolio of 30 stocks. Well, these are the unsung heroes of the previous small cap bull market, that is, the bull market between August 2013 and Jan 2018. These are small caps, that is, outside the top 250 in terms of market capitalization. Now, this was the period when the BSE small cap index went up more than 4 times, a gain of 300%. Any idea how this group of 30 stocks performed? Well, an equal weighted portfolio of these 30 stocks went up by a whopping 22.6 times. Yes, that's right. A portfolio with equal amount invested in each of these 30 stocks would have seen every single rupee turn into rupees 23 in a short span of 4.5 years. Put differently, this portfolio would have turned into a 23 bagger as compared to the 4 bagger BSE small cap index, a huge outperformance by any stretch of imagination. Well, this bull market ended in Jan 2018 and the markets did not start recovering until March 2020 when the BSE small cap index had crashed almost 56% from the top. Yes, from its highs in Jan 2018, the BSE small cap index fell a whopping 56% before it started recovering from March 2020 onwards. And what a recovery it was. Between March 2020 and December 2024, the BSE small cap index has gone up an impressive 6.5 times. Yes, in the bull market between August 13 and Jan 2018, the BSE small cap index went up 4 times, but this time the gain is even better at 6.5 times. Now let us go back to our portfolio of 30 stocks which I showed you earlier and which did so phenomenally well in the previous bull market and were collectively up a whopping 23 times. So how did the same group of 30 stocks perform in the next bull market, that is between March 2020 and December 24? To be honest, the performance was a little underwhelming. The same group of 30 stocks which went up by 23 times in the earlier bull market were up by only 6.3 times in the current one. Yes, they did not even manage to outperform the 6.5 times returns given by the BSE small cap index. Although the performance is not very poor, it is not very good either, and it definitely pales in comparison to the time when they're up 23 times in the bull market between August 13 and Jan 2018. Well, this tells me that if your stock is a multi-bagger and has outperformed the benchmark index by a huge margin, it may not end up being an outperformer in the next bull market. The group of 30 stocks we just saw failed to outperform in the most recent bull market. Now, they did wonderfully well in the previous bull market but could not repeat the stellar performance in the most recent one. Hence, it may not be a good idea to buy more of the same multi-bagger stock in a stock market correction. The new bull market, whenever it comes, could give rise to new multi-baggers and new themes. The old multi-baggers and the old themes may no longer work. It won't be a bad idea, therefore, to buy a new set of stocks instead of averaging out the existing multi-baggers. But which stocks exactly? How do we identify a new set of stocks with the risk-reward equation in our favor and with a good chance of outperforming the benchmark indices? Well, the most recent small cap bull market, that is the bull market between March 20 and December 24, saw the BSE small cap index record an impressive gain of 6.5 times. Now, what if I tell you there is a group of 30 stocks which did significantly better than the BSE small cap index and were not at all hard to shortlist. An equal weighted portfolio of this group of 30 stocks went up an impressive 15.5 times between March 20 and December 24. Yes, that's right. A portfolio with simple buying rules managed to do something that the multibaggers of the previous bull market did not manage to do. That is, outperform the BSE small cap index. But what are these simple buying rules and how did they help in putting together a portfolio of market beating stocks? Well, the buying rule is simple. You want to buy a rupees 100 note for rupees 80 or lower and make sure that the company does not have a lot of debt on its balance sheet. Put differently, all the stocks in the 30 stock portfolio were bought at price to book value of between 0.3 times and 0.8 times and had debt to equity ratio of less than 1 for the latest financial year. That's it. There was no other rule. The 30 stock portfolio was chosen from the small cap universe, that is, the universe of 500 stocks outside of the top 250 in terms of market cap. So, all the 30 stocks came from this universe of 500 stocks, such that they were trading at a discount to the book values and had debt on the balance sheet less than equity. It is this simple portfolio that gave an impressive return of 15.5 times in the most recent bull market, that is between March 20 and December 24, and managed to outperform the benchmark index return of 6.5 times. I believe what worked in favor of this portfolio is the very attractive valuation as well as the low debt on the balance sheet. By ensuring that we are not overpaying and we are buying a decent quality stock, we were able to have the risk reward equation firmly in our favor. Therefore, a simple portfolio of attractively valued stocks and strong balance sheets was not only able to outperform the biggest gainers of the previous bull market, but also the benchmark index itself. So, those who are looking to buy a new set of stocks and do not want to average out their existing winners should consider buying based on these simple rules. But please know that when you buy such stocks, you have to buy them in a group of at least 15 to 20 stocks, if not 30, and not shortlist 2 or 3 of what you think are the best ones. This is a group based approach to investing and not individual stock picking. You have to look at the performance of the group as a whole instead of focusing too much on individual stocks. Therefore, just to summarize, the multibaggers of the previous bull market may not necessarily outperform in the next bull market. Hence, instead of buying more of an existing multibagger in your portfolio, especially after a bear market, you could be better off investing in a new set of stocks. This new portfolio can be based on simple buying rules where you're buying at attractive valuations and ensuring that the company is not highly leveraged. You need to buy at least 15 to 20 such stocks and take a group based approach and then hold it for at least 2 to 3 years, if not more. A new bull market may need you to invest in a new set of stocks, and the criteria we just discussed may not be a bad place to start. Let me know whether you agree with me or not, and what do you think of this approach. That brings me to the end of this session. I'll see you again next time. Goodbye and happy investing.